This is a paper that's currently called the beta of the value factor. Beta predicts the value premium, and this is sort of in a fairly early stage, pre-submission stage. So obviously, I would welcome any comments that you might have. So basically, we'll look at the value factor, and this is talk a little bit about anomalies, and this is. I guess many people think of the value factor as the biggest anomaly out there in asset pricing, the cross-section of asset pricing, and this is sort of the fact that many sort of these value growth-related characteristics tend to predict the cross-section of stock returns. Book-to-market, price-to-earnings ratios, long-term price change, etc., have predictive power for the cross-section of stock returns. The question is, why is this? And of course, the standard rational explanation is that such predictability is reflected somehow to differences in risk between value and growth. On the other hand, I guess some people have argued that this is somewhat limited success in this. The standard sub-rational explanation or behavioral, if you want, is that there are some naive investors in the market, and they have excess demand, and that could be driven by some preferences, biased information process, or whatever, for stocks that have certain characteristics that's correlated with growth, and so this leads to overpricing the current period as naive investors buy up the growth stocks, and sort of long-term reversal to fundamental value, and which leads to the underpricing, overpricing today, and then underperformance in the future. Now, so we'll look at if risk will have. We'll start looking at sort of the fundamental. The first step is always, I guess, to look at the betas, and let me just do a little bit of technicalities first. So we'll look at sort of long, short factor portfolios for a number of characteristics. And so think sort of value minus growth. And so in the long leg, we have the value portfolios. In the short leg, we have the growth portfolios. And so the beta, so the factor portfolio is like a zero investment portfolio, and the beta of the value of the factor portfolio is going to be, of course, the difference between the short and the long leg. All right, so we have that here, and as it turns out, and this is, I'm not sure if it's well known, but it turns out that all factor portfolios exhibit negative betas. Of course, they have positive average returns, so this would be inconsistent with the standard CAPM predicting this positive relationship. It's not so much new here yet. I'll show you the numbers. But of course, it could be that this could be reconciled within a standard CAPM framework. Even if value stocks have unconditionally low betas, they could have, if times when they have relatively high betas, the expected return is also high. So conditionally, it may still hold the CAPM, even if it doesn't seem to hold unconditionally. So this is our main test. And so we'll look at the expected return to these factor portfolios conditional on this time-varying beta. And we find that the finding here in a nutshell is rather than sort of the factor returns co-moving positively with the betas, they co-move negatively. So the higher, let me get this right. So the higher the beta today, the lower the return in the future in a time varying sense. All right, so this is the contradiction here is worsened rather than helped by looking at the time variation in betas. And the question then is that consistent with any sub-rational behavioral explanation for the value premium? And I'll sort of sketch a very informal sub-rational model that we argue would be consistent with the data. So let's assume the existence of naive investors who's trading affect prices by the whole but the premise is that their trading affects prices, otherwise there wouldn't be an anomaly. And they have a preference for growth, or sort of sometimes called the glamour stocks. This is also, again, just a premise. And they have sort of a high frequency market timing behavior. So they move in and out of the market in a correlated fashion. Right? Now, so I think they vary the allocation to stocks. So the naive investors vary their allocation to stocks. They're going to predominantly, when they go into the market, they're going to predominantly buy the growth of the glamour stocks, and so they will move prices for those stocks the most, but they'll also move the prices for the overall market. But they'll have a lower allocation to the overall market to the growth stocks. Right? So this would be a sort of simple reason for having relatively high betas among these growth or glamour stocks. And of course, is then the activity level or the presence of naive investors is time varying over time. Is time varying, then you will see glamour stocks exhibiting a time varying covariation and market beta. All right, so is this the case? So let me show you a plot of the factor beta that we're going to be computing. And so this is in red here. So we have time from, the data goes from 1967 to 2010. And so here we have in inverted scale the average factor beta. So again, this is value minus growth essentially. I'm going to come to the exact construction of it. And so in the late 90s, growth stocks had a beta that was almost 0.5 larger than the beta of value stocks. Right, so this is an inverted scale, and so this is value minus growth. So growth is going to be in the negative side. There's going to be a negative beta on the short side. There's going to be a negative beta on in the factor. Vice versa, at the end of 2010, the beta was positive with somewhat around 0.1. All right, so there's a huge variation, in fact, in the betas across time. And what I plotted this against here was this is against the Bacon-Wurkler Investor Sentiment Index, and this is actually what got us. Well, it sort of got me excited about this because you can see that the two lines here are very much very highly correlated, almost plot on top of each other. So the Bacon-Wurkler Sentiment Index is well, this is a composite of different measures that Bacon and Wurkjaer argue are related to sort of investor sentiment. If the index is high, investor sentiment is high. And this is things like the closed-end fund discount, the dividend premium, the number of IPOs. There's lots of IPOs. This is a high sentiment, for instance. The important thing is that all of these are sort of variables that have nothing to do with the covariation of returns. Our measure is based totally on the beta or the covariation of the factor stocks, and even if they sort of are, the measure is completely differently constructed, we still get something that looks that's highly correlated with investor sentiment. So this is at least sort of fits well with the existing measures. So this suggests that this could be an alternative proxy for investor sentiment. All right, so the test we're going to make again is if again the more naive investors, the higher the growth stocks betas, and since they're on the short side, then the factor betas will have more negative, there will be more negatives, right? At the same time, the more naive investors, factor portfolios will also be more mispriced, and so we'll have the growth stock will be more mispriced, so there will be greater subsequent reversals. And again, there's sort of already alluded to it. This is sort of the key result that we have. We show in time series regressions that the more negative the factor beta is, the higher the subsequent returns to the factors. And that's going to hold over the next 2 years or so. All right, so we in fact also going to construct, so this is the beta is going to be sort of one key predictive variable for factor returns. We'll also construct a few other variables, namely the factor volatility relative to market volatility. So if there are lots of if naive investors are highly active, they move prices, volatility in the factor portfolios will also be high by the same argument. So that's going to be a second predictive variable. This is not going to distinguish very well between the rational and sub-rational because this could also be viewed as risk. And then we'll look at the dispersion of the relative volatility and of the factors. And if naive investors' preferences vary over time with different characteristics related to some underlying value growth factor, then sort of we'll see a higher, if there's a high mass of naive investors, we'll see potentially a high dispersion. If on the other hand, at times with fewer naive investors under the hypothesis under the sub-rational hypothesis, betas will not vary between the growth and the value stocks, and so they'll be closer. The betas of the factors will be close to zero, and also therefore have a relatively low dispersion across factors. All right, then we'll look at the principal component of these four variables, which turns out just to be close to an equal weighted average. All right, so we're in the business of predicting factor returns and value factor returns, and we'll form factors very similar to sort of the Farmer-French standard, or in fact following completely the HML procedure. So it's forming based on mid-year accounting data, and then value weighting, taking small and large stocks and taking an average of those. And we'll look at that, the data up to 2010. All right, so the characteristics we'll look at, or the factors we'll look at, I've already sort of mentioned, book to market, long-term reversals, cash earnings yield, net stock issuance, net operating asset growth, investments to assets. And so these are all arguably related to some underlying value characteristics, different manifestations of value versus growth. And we'll look at a composite factor, which is just an average of the 7 factors here. All right, so we've chosen these factors because we know they work. So by construction, these are returns that if you've constructed a portfolio based on these factors, you would have experienced the abnormal return over this period. This is by the construction, and so the average portfolio would yield around 37 basis points per month, with a t-stat of 4.9. So there's nothing surprising here. So what we've taken is things that work in practice, things that's already been shown to predict returns. Yes, and so unsurprisingly, given that these, by our hypothesis, are all related to some underlying value, the factor returns are positively correlated across time. So this is the bivariate correlations of the monthly returns. Nothing terribly surprising here, except I should mention that this is not just driven by a common denominator in price, because some of these are scaled by assets and others are scaled by price. And this is establishment of this unconditional market betas. So we compute, so we have the factor returns, we have daily returns, and so what we're going to be computing are a series of betas each month, and based on the daily returns. So this is just to show unconditionally over the sample that the factor returns have negative betas, and that happens no matter whether you estimate this based on daily or monthly observations. This has sort of been shown in different contexts, but I'm not sure that this was well known. All right, so so I get my head of myself here. So we computed, we have these daily returns, and so we compute one measure that we're going to use as a predictor that's going to have a monthly realization. And so we compute a factor beta per month, average relative volatility per month, etc. And that is what we're going to be plugging into the basic specification here. So this is sort of the basic result, namely we're going to predict in returns on the factor returns. So this is next month factor returns regressed on the predictor's value this month. And so this would be either the average of the betas or the relative volatility or the dispersion of those, or the first principle component. Right? So this is the space specification, and we control for sort of the standard pharma French variables, except for HML, because we have HML in the predictor. All right, so I have the factor betas. I've taken an average of the factor betas, and so I have like a value factor that I'm going to use that to predict each of the individual factor returns, and yeah, you can see the t statistics here. The R squares, of course, are not so relevant for this specification because I have control variables that are contemporaneous. All right, so I do this for the relative volatility as well, similar effect. And let me just take the first principle component. And so predicting the composite factor returns with the first principle component yields a slope coefficient of 0.34. So this is about a 34 basis point move given a one standard deviation move in the factor. Sorry, in the composite factor. All right, so this was next month returns. How about longer horizon returns? So here we do sort of similar exercise, except that we are sort of holding the 1 month factor return constant, and then we're looking at a longer horizon over which we construct the predictor variable. And so this would be the 1 month return. So this is sort of similar result as I just showed you from before, namely using the last month first principle components predict this month composite factor returns. And then this is sort of the predictor computed over the prior 6 month, and then the 12th month, and the year before, sort of month 13 to 24. All right, so effectively what we find is that the predictor variables are successful up to 2 years in the future in predicting factor returns. And there's nothing essentially in the third year. Another way of looking at the longer horizon predictability is to predict, computing the predictor over a 1 month period, and then L month ahead predict the returns. And so this is doing it for the composite factor, and then looking up to 36 months into the future, using the first principle component, and here I'm plotting the t-statistics. So here we see we have very high t-statistic in the beginning, quickly drops. In fact, it's insignificant here in sort of 6 to 10 months, but it's generally significant over the period of sort of 1 to 2 years. These are all in sample, what I've shown you so far. Of course, we know that lots of variables work extremely well in sample, but not so well out of sample. So we run sort of the standard out of sample tests as well. And this is sort of doing rolling regressions, where we're estimating the coefficients on the predictor using the period, not using the full period, but using the period that goes up to the month before we predict the next month returns. And so we plug that in, we have the coefficient, we then plug that into the next month and compare the prediction with the average returns. In fact, results hold up out of sample. This is, in fact, the R squares are reasonably large out of sample as well. Are we doing? So, as it turns out, it's not the factor's own covariance that do well in predicting its future returns. Namely, so recall what I've done here is I've taken, I have these 7 factors. I'm computing a beta measure across the 7 factors, taking the averages for the betas, and I'm using that average to predict the individual factors, as well as the composite of the factors. If you just run the same exercise with the individual factor, namely using the past beta of the book to market to predict its future return, in fact, we have limited success. It works basically for, well, at the 1% level, only for 2 of the 7 variables. On the other hand, we do have much more predictive power coming from the covariances of the other factors. So using the 6 other factors to predict book to market is more, well, book to market is maybe not the best example. It's only significant at the 10% level, but across the factors, more power, predictive power comes from the other factors, not the factor itself. So it's a little more subtle than just predicting the own factor. This could be for different reasons, presumably attributable to we're better able to extract the signal about some underlying value factor using different manifestations or different dimensions of value. So it seems like this sort of signal extraction exercise by averaging across different factors is useful. Yeah, this is plugging this is estimating jointly. Now, so this is arguably, given it's highly correlated with the Baker-Wurkler investor sentiment, and sort of given the naive investor hypothesis, this sort of seems like a reasonable investor sentiment measure. And of course, other researchers have looked at the predictive power of investor sentiment. In particular, Stambaugh, Yu, and Yuan find that the Baker-Wurkler index predicts the risk premium related to some of these characteristics, some of these factors that we've looked at, namely net stock issuance, net operating assets, asset growth, and investments to assets. If we do the same, we with the Baker-Wurkler index, we in fact find very little. This is sort of running the same regression and plotting, putting in the Baker-Wurkler index as before, with and without our measure. So this is the first principal component. And it is, let me get this right. So basically, this is, so we are predicting the composite factor returns on the left-hand side. On the right-hand side, put in the Baker-Wurkler index alone as insignificant. They have like an orthogonalized measure with some macroeconomic variables. Once you do that, it's sort of marginally significant. But if you include the first principal component from our measure, ours is highly significant, unsurprisingly, but the Baker-Wurkler is insignificant. And also for the individual factor returns, it's not particularly significant. On the other hand, we also look at two other alternative sentiment measures: the Michigan, the index of consumer sentiment from the University of Michigan, and this American Association of Individual Investors Bear Spread. And the Michigan sentiment doesn't particularly work, but the investor sentiment here, the AAII sentiment, in fact, seems to complement our measure. Both are significant. Now, why doesn't the Baker-Wurkler index? We were surprised by sort of the lack of predictability here, given the results in Stambaugh et al. And so what they have are decile returns. So we have these this HTML type portfolios. They form deciles and look at the decile spread. And it turns out that if you do exercise similar to that, Baker-Wurkler does in fact predict the short side, namely the growth stocks. It doesn't predict the value stocks, but it does predict the growth stocks for some of the characteristics that we've looked at. And on the other hand, unsurprisingly, again, the first principal component predicts, in fact, both sides of both the growth stocks and the value stocks. All right, so this was a bit of time series evidence. How am I doing on time? 5 minutes?
Well within that. At least 5 minutes.
Yeah. So let me show you a bit of cross-sectional evidence as well. And so you might expect that the predictors also, the question is, do the predictors also explain the cross-section of average returns? So we might expect that stocks with, given the sort of naive investor story, we might expect that stocks with the lowest returns following high realizations of the first principal component, that is high sentiment, would also be the ones that have the lowest average returns, namely those are the stocks that are most affected by sentiment, sort of the growth stocks. All right, so we'll test that in a standard Farmer-Macbeth framework. And we talked a little bit about test assets early on. And so the Pharma French 25 portfolios, of course, have been criticized as test assets, as sort of being easy assets to explain the cross-section. So Llewellyn, Nickel, and Shanken propose supplementing those with the 30 industry portfolios from Pharma French. And those are sort of harder test assets to explain the to capture the cross-section returns, and indeed most models get very low R-squares in these. And so this is sort of a standard framework. And so what we'll do, we want to get the sensitivity. We have constructed our predictor, which is the first principal component of this series as before. And so we'll run time series regressions of the individual portfolio returns on the realizations of the predictor. And so we're going to get a sensitivity to those. And we're going to plug that into the cross-section. This is sort of standard Farmer-Macbeth. Now, I don't want to sort of overstate the results here because we are going to be using full period returns to get at the predictors here. This is similar to sort of Farmer-Macbeth, but it's not Farmer French 92, but it's not a purely. I mean, we could be subject to look-ahead bias here. So, if you just look at the Farmer French three-factor model, how well does that do in predicting these 55 portfolios? Well, there's an R-square of about 28. So Llewellyn et al. Get about 31% R-square, so this is sort of similar. If we plug in just the first principal component from our series here, the R-square is 0.36, so it doesn't indeed seem to capture quite a bit of the cross-section of stock returns based on this. And sort of it retains its significance in controlling for the farmer.